What's going on, everybody? I literally forgot how to get to the comment section. What's going on? There we go. Jeez. All right, guys. Sorry I am late. I didn't wake up very good. My stomach was hurting. I didn't get enough sleep. Sometimes when I just wake up, my stomach hurts. All right, guys. Little rough day right now. Let's see what's going on. Let me see. Okay, wait a second. All right, can y'all see that? Let's see. All right, look at the chip stocks today, right now, guys. These are getting hit the hardest. You see that? Nvidia 11. I think Nvidia hit 12 or 13%. Broadcom 14. So you guys can see what's happening. It's a rough day right now. Good morning. Good morning. 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 Yes, rough. Really rough. Really rough. All right, let me get this. Let me get this stream out. Okay. Share this to Twitter. Live right now. All right, guys. Just posted that on Twitter. All right, guys. Brain is just frozen right now in this market. What's good? Belgium. Everything on sale. Nvidia at the critical support level. What's going on? What's going on? Germany. Temporary. I'm not feeling very good because I went to bed at like 3. So, because I was tweeting to you guys all night and set my alarm and was like looking at the market. I was like, I know it was down, but I was like, man, this is crazy. I mean, do you guys see what is on the screen right now? Do you guys see that? Look at I mean, you guys want the dip on some chip stocks. There you go. Look at that. Oh my God. Broadcom 14. What the heck is going on? These are all good companies too, guys. These aren't like unprofitable names. These are names that have been around forever. I mean, I can't believe the market's moving like that. What in the heck? This is crazy. All right, guys, we gotta steal the show, right? Today, if SoFi drops something crazy and we steal the show, guys, a lot can happen until the market opens because the earnings are going to come out at 7. So 2.5 hours from here. Okay. There's a lot of money coming out of chips right now because of what's going on in China, with this new app called Deep. I already forgot what it's called. Deep Streak. I got to look it up again. Put it on my Twitter. This new app competing with OpenAI for 10 times less the cost. Yeah, Deep Seeks. That's what's crashing the market right now? I don't even believe it's true that did all of this, they did all this testing on $6 million. I don't believe that. I mean, that doesn't make sense at all, but that's what's crashing the market right now, guys. So I don't even have SoFi up yet right now. I just want you guys to see what's going on inside of the overall market before we even focus on SoFi. But that whole AI thing that we were going through the entire 2024, that AI boom, I mean, this is what happens when you potentially have someone that's gonna, compete out there with all these other AI companies. Overreaction. It's a lot to take in. Scotland, Australia. Come on, man. Denmark. Wow. Deep discount. Overreaction. Buy some dips. All right, guys. You can share this stream, put it on some chat forums, StockTwits, Reddit, Twitter. Let's try and pump these numbers up to 2,000 at least. We're at 1,600. Smash the like button. We got 28 minutes to go. And guys, with Nvidia down 11, Broadcom down 13, Taiwan Semi down 10. I mean, SoFi is down about 4% today. It hit lows of like 1680. I mean, we hit that like a week or two ago, so we are down about 4% right now. It's not too bad. Robinhood 7, Palantir 6. I mean, it looks like the only company like doing better than us is PayPal, and PayPal's down 2%. Firm 6, Upstart 5. I mean, I think earnings today could be the best case scenario. Am I wrong? I think earnings is the best case scenario today because this may get us out of this freaking hole that we're in while nobody else can show off their numbers. So, yeah, we're getting smoked right now, but this may be, a gift to have your earnings today if SoFi has really good earnings. Okay. So, yeah, I did not understand. This is crazy. So, I mean, who's buying some chip stocks? Is that what you're looking at? Are you guys skipping chip stocks and, looking at like some of the other names I said? Like what are you guys buying today? I looked, I saw QQQ down 6% or 5%. Crazy. There you go. Buying opportunity. Boom. Nvidia, Microsoft, Israel, DeepSeek, Steve in the Mountains, SoFi to save the day. Philly's killing it. Good morning. Never know. I mean, they're doing all right now. This is good for Nvidia. Yes. Man, you guys are holy crap. You guys are 4 minutes ahead of me. All right, I got to skip to the top. Here we go. Canada. AMD buy. There we go. I like to hear the buys right now. This is good. We can help people look for opportunities. Market's waiting from a reason. Yep. Let's go. Let's go. Wow. UK. Nvidia. 25 minutes. AMD. No more chips. Dell. Okay. Whoa. Holy crap. Give you guys a little couple other stocks update real quick. You want to see? Here we go. We got Coinbase 5, Hood 6, Palantir 5.5, SoFi 3.5 now, PayPal 2.5, XYZ Block 6, Affirm 5. So these are kind of all the same right here. It looks like the big buying opportunities today are chips, right? I mean, it looks like the buy of the day was Nvidia at 13% down, right? That looked like the buy of the day. Now Broadcom's looking like a dip lower. So yeah, what are you guys buying? What are y'all buying? Anything? Palantir was 10, Tesla 390, chips crazy, buying opportunity. Dip buying. Let's go. Amazon. Let's go. Appreciate it. SMCI, Lunglen. Don't buy a falling knife in AMD. Yeah, I thought it was a decent buy at 120. DeepSeek, Microsoft, Netherlands. Let's go, guys. Hmm. ASML, Alo. 33% in SoFi. I mean, maybe, yeah, it was looking pretty good at 13.5%. I was like, dang, maybe it's time to snag some. SMH, that's the whole chip thing. Tesla, Nvidia, SoFi, Tesla, AMD, Palantir. All right, guys. So let's see. SoFi right now, it's down 3.5. I mean, you could say it's one of the better performers if you look at like 10 other, you know, fintech tech names like Upstart, Affirm, Block, Nubank, Palantir, Hood. It's performing the best right now, probably anticipation of earnings. But I mean, are you guys not happy we're reporting today? I have confidence that management will have good earnings today. Well, so why isn't it a good day for SoFi to report? I mean, think about it. The entire market's freaking out. People are selling. So there some money needs to go somewhere, right? Is this not a good day to report earnings? To report a good earnings? A really good 2025 guidance? I like today. I like we were down what 5.5%. We've been down 5.5% on other days. So is this not a good day to report earnings? Are y'all scared? I mean, I think about it. We had this AI hype for a year. And remember, the market thinks SoFi has zero AI. It's a bank. We're finally getting a small multiple flip because of the loan platform business. Is this not? It's a great day, right? Am I losing something? I mean, yeah, you're probably feeling the pain if you're in chips today, but this is what we have. We have the best day there is. Guys, I made a video. SoFi reported Q3 with 200 companies, 200 other companies, Google, AMD, Chipotle, PayPal, massive companies. And today, we're the like fourth largest company reporting out of 40 other companies. We're top four. Like we're at the top of the list. We're the number one today. I mean, I think one company, AT&T, has a bigger market cap, but we have the most eyes today. The street is watching SoFi. This is an earnings date built for SoFi specifically. It was built for SoFi today. This day was for SoFi. There's no other big dog companies reporting today besides AT&T. This is our day. So I'm happy. I mean, I'm happy we're reporting. So that's how I see it. So if you listen to management, Anthony Noto specifically on the Q3 report, the guy wasn't even talking about Q4. He wasn't even concerned about Q4. He just kept bringing up 2025, next year's macro. When did our back? You have no idea what's in store. We're just getting started. I think they're gonna pull something out of the rabbit out of the hat for 2025. I don't know what it is. Is it a massive? Is it 10 billion in originations for loan platform? Is it a potential Galileo top five, top 10 whale? Something's bringing him confidence, and I don't know what it is for 2025. I just don't know what it is. It's something that other companies are not seeing for their direction. So this is the day. This is the perfect day. Okay, let's go. Good morning. It is. It is. It is blood red. Been red. Let's go. 7 o'clock. 7 o'clock. We got almost 2,000 people. Come on, guys. Just smash the like button, drop a comment, share the video. Let's pump up these numbers. This is what we've been waiting for. This is it. We're almost there. Like 17 minutes to go. Crazy day. But guess what? If SoFi blows it out, it's going to be nonstop SoFi articles everywhere, guys. Every single media outlet. CNBC is going to be pushing, trending on stock trips. I mean, there's a lot of money, coming out of the market right now. Pre-market money wants to go somewhere. Institutions, may see a lot of competition with AI right now, and these companies in the private markets, and may want to flip to fintech because fintech it's their year right now. It's the time. It's what we've been waiting for 4 years on the public markets. Let's go, guys. This is it. What's going on? 15 minutes. Yeah, we're looking, it looks like, there's like 4 chip stocks that are hot right now if you guys want to super buy. Appreciate it. So it's up to you, It's up to you. There was bigger dips when KBW was coming out with $8 and $6 price targets. We hit about, 13, $14, That was a couple of weeks ago. That was a buying opportunity. There's this company called DeepSeek over in China that's supposedly dominating other AI companies in America right now with 10 times less the cost and twice the efficiency. Uh, who knows if that's real, but that's what's going on. He said it's not the perfect day. Okay, it's not the perfect day, I get it, but it's still a good day for SoFi because we can at least release our numbers. These other companies down 14%, they can't do anything. They just sit down 14%. At least we can like make the market think, oh, whoa, 2025 forward looking dominance. Oh, something's happening next year. All this money on the table right now that is getting pulled out of chips could go into SoFi, other companies like SoFi, fintech sector. So let's see, SoFi, yeah, down 3%. I mean, we were down 3%. We were down 3% the last report before earnings. I remember, guys. I mean, we were down 2, 3%. I swear I remember going back. The market was fine. It was a normal day in the market. They were just doing the same crap with SoFi, 2, 3%. It always happens. There's probably people selling out too with the other, stocks today. So Um, chips. Yeah, guys. I mean, that's crazy. Just Nvidia, Broadcom, and Taiwan Semi. Are those the like best buys in the market today? That is crazy. God. Yeah, it might. It might. It might. Let's go. Now that I've been thinking about it, I don't know if they're very concerned at all with the Q4 report specifically. I mean, Wall Street estimates are 4. They hit 5 last quarter. I said they're going to do 7. They might do 6, okay? But it doesn't really matter to be honest. It's what's for 2025. That is what matters, and right now the magical number, just remember, is 29 cents. So once the investor presentation comes out, you may want to just skip the Q4 and just go to like page 5, 6, 7, or 8 or something like that, and just look for the consensus against the 29 cents. That's what you want to look for. And I think they're going to come in over that, be conservative probably like they usually are at 30 to 32. I feel happy with 30 to 32 because that beat out Wall Street by 3 cents on the top end. So I'm looking for 30, 32. Remember those numbers. 29 is what Wall Street wants. That's really all I'm looking at. I'm not looking at like any other metric for next year right away. That's the most important metric is the 2025 EPS. So 29 cents Wall Street, 29 cents Wall Street. Go out, look for that. So that's what we're looking for. See website. What does that mean? I don't understand what that means. See website on SoFi, numbers delayed by 20 minutes. My stuff's live wherever. I don't know where you're at, but my stuff's live. SoFi. I don't think so. Let's go, guys. God, we're getting, holy crap. 2,250 live. Jeez. Let's pump it up a little bit more, guys. We got 12 minutes. 11 minutes. 11 minutes till the numbers come out. This is it. This is it. The China news will overshadow any news, my brother. Let's see. I mean, we're gonna have to see. Uh Q4 680 million, just 682 or 678. Just call it, yeah, say 682 for revenue. 682 is for Q4, and 4 cents EPS Q4, and then 29 cents 2025. That's it. I'm really not concerned about Q4. I think they're going to put a 7 handle on it probably. Like I said, 6, 7 cents. And I just want to see what they're going to do for 2025. You listen to the commentary from management, something is weird going on behind the scenes. Like they have something coming. I don't know if it's the loan platform business or Galileo technology is going to explode. I'm not going to tell you guys they're going to sign a deal right now today, but they've been in talks for 2 years with these top tens. I mean, if there was a day to announce a top 10 whale, like the greatest day to ever announce it, today would be the greatest day to ever announce it. Why everybody's talking about China, DeepSeek, AI, chip stocks. This would be the greatest day to announce a top 10 whale. Just saying. Because that news would, oh my God, today's the perfect day. So we'll see. Yep. I said, yeah, NVIDIA is a good buy. 25. Love you, man. Appreciate it. SoFi's going. Yep. That's a top 3 today. Let's 2%. Can you guys see? Let me see. Can you guys see? Okay, we'll go. Okay, I'll move off the chip stocks and we'll just stick to SoFi for now, if you guys want, because we're getting close. So SoFi is down 3% right now, as you guys can see. It was literally down the same freaking last report. It was down the same, so it's nothing to be worried about. 9 minutes. 9 minutes. 9 minutes. 9 minutes. Yep, that's good. Let's hope it crashes. Let's go. Yeah, I know. Tell me about it. All right, guys, I'm gonna fast forward the comment section. I mean, I'm reading them pretty freaking fast, as you can see, but we got to get to the top now. Okay, here we go. Let's go and see. Let's go. What do you expect? So, guys, I was very happy with the Q3 report. I mean, Q3 report. I remember as we sold off like 10.5%. That report, I was so happy. After that report, I was like, man, this company's growing. They're trying to shake us out. I was so happy after reading that last report. I was like, man, these guys are building something special. I think we're gonna laugh at those numbers potentially, those Q3 numbers when we look at what they're gonna put up for this upcoming guidance and stuff like that. I think we're gonna understand we're holding on to a giant in the making. Appreciate it. Let's go. Let's go. Let's go. 7 minutes. 7 minutes. You never know. Like that whole $6 million they built their model on that 6 million, but it could be a lie. You never know. 7 minutes. Yep. 7 minutes. Good morning. That'd be crazy. Yep. What's going on? Yeah, man. I'm not sure. Let's go. Tips little money. Yeah, guys, there's a lot of money on the sidelines right now. You know what I'm saying? There's a lot of money out there. Just it wants a home. It wants a place to go right now. Let's see what they got, man. I'm excited. We're all excited. Appreciate it. No, I really don't. I really don't, guys. You see the titles and stuff. That's just to tell people the truth. If there's a thumbnail or a title to get people to watch a video and more people become confident, that's a success in my opinion. So that's what I do on these like little SoFi's crashing on Twitter and stuff like that. And then that gets people to look and they're like, wait, it's crashing for no reason at all. This is an opportunity. So that's why I do stuff like that. I've already said that the last report. So the earnings call is an hour, 1 hour after the report. So they're going to report their numbers, and then you have 60 minutes to digest the numbers, and they do their earnings call to talk about the numbers. So they give you a 60. Wait, I can't remember now. I always forget. Earnings at 8. Yeah, I know the numbers are going to come out in 5 minutes. So let's see what we got. Let's go. 5 minutes now. Let's go, guys. I mean, what are we doing? We're betting on a management team that was very conservative for 6 months in 2024, and from their commentary, they don't believe they have to be as conservative, and that's good for growth, and that's good for more profits, right? So, thank you, China. Let's go. Morning. Let's see it. Let's go. I'm definitely nervous and excited. I am. Fingers crossed. I am. I didn't sleep well last night. 4 minutes. Comments, you guys are coming in so dang fast. Jesus. My God. Let's go. I love that. Great time. Let's go. Bite it deep. Here we go. SMCI. Oh my God. 4 minutes. Jeez. Jeez. 4 minutes. My God. What is SoFi doing right now? SoFi is down 4%. Jeez, this market sucks. My God. All right, let's go to the top. Here we go. Let's go. It's realistic. It does that. I mean, guys, think about it. Freaking, I can't like come out and do a video right after earnings. We're gonna see the earnings right now. It's gonna be the truth. You know what I mean? Whatever we see, it's the truth. There's nothing to sugarcoat. You know what I mean? This is it. Like the numbers are the numbers. That's why we do it live. So I can tell you. If you go back 12 months ago and you saw my reaction, I wasn't very happy 12 months ago when they headed into the 2024. It was the Q4 2023. Now we're in the Q4 2024. So 12 months ago, you could have saw my reaction. It was bad. And guess what happened? The SoFi stock didn't do anything for 6 months. So let's see what we got. All right, 2 minutes. Here we go. I'm gonna look for the report. Um, yeah, okay, 2 minutes. Here we go, guys. 2 minutes. Y'all ready? That's it, guys. Here we go. That's it. 2 minutes. 2 minutes. 2 minutes. 2 minutes. 2 minutes. Here we go. That's it, boys. That's it. Here we go. 2 minutes. I remember 2 quarters ago, SoFi was a little later on the presentation, so I found it on StockTwits. Then I flipped back, so I got it later. So I'll just try to go back and forth to see which one comes out first. It might take me 2 minutes to get the numbers. We might not get them immediately, but at least you'll get the right numbers. We won't get no fake numbers, people trolling and stuff like that. So, all right, guys, 1 minute. You're gonna get the SoFi Q4 report and the 2025 earnings. We'll throw in one more thing. Maybe they increase 2026 guidance. If they increase 2026 guidance, that is freaking amazing. You may get that today. You may get that. All right, guys. Few seconds. That's it. All right. I'm going to go and try to hunt down these reports. That's it. Good luck. Here we go. 7 o'clock. We are here. 7 o'clock. Numbers should be coming out any second. Any second. I'm on the SoFi investor presentation. Oh, man. Oh, man. Come on, man. $701. I'm on the SoFi website. Just the Q3. Come on, man. What is this? don't got it yet. SoFi is moving up now. What the heck is going on? I'm trying to find the business wire. Hang on. Every quarter they're getting slower and slower and slower. Like I see one on here, but with the I just want to make sure I get the right numbers. Why don't they just post it on their website? Okay, here we go. 734. Boom. That's it. 734. Net income of $332 million. That must have been something, some kind of boost. No, um, 734. Okay, they smoked revenue. We see that. Hang on, guys. They're just like they were just so slow on their report, like their presentation. They put it out so late. There we go. Golly, that took forever. Okay, EPS adjusted was 5 cents, so they beat the 4 cents. Wasn't a crazy, like I said before, the Q4 wasn't going to be a blowout or anything like that on a profitability after going back listening to Noto. Um, let's see. They're doing a lot of different spreadsheets now. Holy crap. Oh wow, this presentation is brand new, like the way they're doing it now. Let me see. EPS was 15 cents on the year, guys. They smoked full year. Oh my god. What a Oh yes. 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 Revenue growth next year is really good. The EPS, it came a little soft. Let's see how the stock's reacting. Yeah, stock's down 5.5%. Okay, let's get to this. Yeah, guys, the EPS came in soft. Let's see. Yeah, 5 cents. That's correct. The guidance was 27. Okay. Here we go. Okay, guys, here we go. They had 26% growth for the year 2024. Pretty good. They started out their growth rate at 14 to 16, came up to 26. Um, Adjusted EBITDA, 26%. Right here, they beat EPS 7 to 8 original, came in at 15. Here's the 2025. They gave the Q1, and yeah, this is pretty low. This is before right now. So net revenue, guys, full year 2025. Look at this. This is really high. Wall Street won at 18%. They're putting out 23 to 26% for growth. Net income 285 to 305 million. EPS right here, they came in a little bit low, 25 to 27. Let's see what they said. Member growth. 2.8 million members. Okay, Q1 2025 guidance was 725 to 745. Okay, I was looking over here for a second. Assumptions, interest rate outlook consistent with the forward curve and just north of 1.5 rate cuts. So they're putting out 1.5 rate cuts. I thought they were going to put out one. So if we get 2, 3, 4, it's pretty good. GDP expansion 1 to 2%. Unemployment 5%. And the stock's down 10%. So, okay, that's not the best. Let's see. 16. Pre-money is going down the drain. Share price is, we'll go back over here, down 10%. Look at this stupid. Yeah, the revenue growth was really, really good. The revenue growth was they're already guiding 23 to 26. Last year they guided 14% revenue growth. Now they're up to 23% revenue growth on the bottom end. I'm surprised they went so soft on the EPS. I'm surprised they didn't go. Surprised they didn't push it to 29. Because I know they like to. We might get some good news, like they might announce some good news or something with this guidance. You know what I mean? They might release something. I don't know, but I'm just surprised that they didn't want to beat the 29 cents. That's the only thing I'm seeing right now. Was they smoked the revenue, guys. Revenue growth, right here. Revenue growth was for 18% for 2025. So, and look at this. They destroyed the 18%. They came in at 23 to 26. Destroyed the top end revenue, and then the EPS. They were supposed to be at 29 cents. So maybe it has to do with the slower rate cuts or something like that, because they're only predicting 1.5 rate cuts. I said they were going to do one. So even a margin of 30%, net income margin of, yeah, I mean, I think they're gonna increase a lot, on this net income profitability for 300 million. I mean, think about it, guys. If they get to, let's call it 37 cents, this is gonna be like $380 million for next year. Almost 220 to almost 400. I think they're gonna increase a lot. I'm just surprised they didn't. I'm really surprised they didn't put 29 on this at least right here. This number. I'm surprised they didn't put 29 on this number right here. I am very, very surprised. That is, it's crazy. Yeah, stock's getting hit because of the guidance. Um, let's look more into the numbers for the actual. I want to see what they did for. 1 second. All right, let me. I want to see how Galileo did. Here we go. So, wow. Originations hit a new record, guys. 7.2 billion. Smoked Q3's originations. Holy crap. Technology. Yep, their technology platform flat right here. 102 to 102. All our predictions were for 110, 112, 113. So the technology platform didn't do well. And then financial services, another $20 million jump. Contribution profit one. Yeah, so guys, lending did amazing right here. Lending did amazing. Financial services did amazing. The tech platform stagnant. That's not good at all. Stagnant for Q4. Let's see if we can find out. Let's see one. Yeah, guys. Honestly, I mean, it was the guidance for revenue growth very impressive to start because they went from 14% last year, finished out the year at 26% growth. So they went from 14% guidance, grew to 26. Now they're increasing their growth from 23 to 26 to start. So they're gonna grow a lot next year. I'm just surprised the EPS didn't come under the 29. That's it. That's all. That's what I'm seeing right now. The EPS was just could have pumped it up 2 more cents. So let's see your comments. Let's see what we got real quick on the comments. I mean, it crashed like 10% 3 different times last month just off the $13, $8, $6 price targets. You think it's gonna go back? I think it depends on what Noto says. I mean, that guidance doesn't look like he wants the $45. It just doesn't look like it right now. We got to hear what it doesn't look like he wants the $45 bonus package right now. Bad. Ooh, that's a tough word. Like I said, last year was 14% growth guidance. This year's up to 23% growth, and they missed analysts by 2 cents. I don't know about bad. I don't know about bad. Yeah, like I already said, I'm surprised they didn't hit the 29 cents EPS. I'm very, very surprised. That's just what I'm seeing. Let's fire okay. Yeah, see this. I didn't even look at that. Let me take a look. The members. Let's see if we can get the members real quick. I didn't even look at that number yet. It's not a holy crap, man. This is like a guys, this slide, this presentation It's like they redid the whole freaking thing. Like that's why I'm like going through this thing and I just haven't there's so much new stuff on the slide. So they're at 10.1 million. So where is the new members? They don't have individual. This is really good growth for last year's conservative year. Look at the EBITDA margin jumped up 5%. First full year profitability, a 9% margin, 15 cents. Guys, they're going way higher than what they put out. That's for sure. Man, right here, I can't believe they put out 27. Why didn't they just put out 29? That is crazy. Why would they do that? Jesus. I gotta go through this, guys, but I mean, this is what you. This is impressive. This growth rate right here. This is really good compared to 14%. This is your number that got you right now. This is why we're down 10%. This EPS 27 cents. The assumptions, interest rate outlook 1.5 cuts. GDP expansion 1 and 2, unemployment 5. Damn, man, why did they go so conservative? That is wild. Why wouldn't they just beat the 28, 29? That's 3 cents. Sell, sell, sell. Coin. Yeah, there you go, right there, guys. That is oh my god, why would he do that? Why couldn't he just get a little more aggressive and hit the streets numbers right there? Two fucking pennies. 2 pennies, bro. Why? No, that's not true because they put out like 6, 7 to start the year last year and they beat it by 9. So they were to beat this number by 9, they would be at like 36. That's what I'm saying. Like maybe they want a massive beat year over year, but this just slows them down a lot, for this like right here. They could have just, you know, took the risk. 2 cent, took the 2 cent risk. Yep. See, look. Now you guys are starting to get it. Like I said, that's the only like I said, this affects the bonus package, the 45 by 2026, the $45 level. So this is what I'm saying. Like a deal or something hasn't closed, and they the numbers on the profitability side are just a little lower. So um, Just change it. Yeah, exactly. I think 8 o'clock. Calm down. No, what? When 8 o'clock. Great earnings. Soft guide. They always do that for the Q1. Honest. Hold. That is right. I mean, that did work. Agree, don't sell. Good news. Who's selling? Very profitable. Who else you selling? The report is out. Bro, just be humble. Maybe you were wrong. I already said that. I already said the guidance was under what I predicted. It's under Wall Street predicted. I already said that. What are you talking about? I said I'm very surprised they put out that EPS, and look what the EPS did. The stock's going down. What are you talking about? Like, Jesus. I'm surprised they didn't put over 29. And they got them. That's crazy. Down 13. Okay, man. Yep. They beat revenue Q4. They beat profitability Q4. They beat revenue guidance 2025, and they did not beat EPS guidance for 2025. Not in denial. I already said it. We are down. All right. Let's look. We are down 12%. How is it? So now we're. Yeah, I'm very excited to hear what Noto has to say on this call. Let's see. I want to see what Wall Street's saying now about these earnings. Let me take a look at what people are saying. Okay. SoFi posts strong earnings. CEO says best is yet to come. Revenue 720, 745 versus 690 guidance. What is this? Huh. This one says this article on TipRank says consensus 25 cents. That don't make sense because that would mean they beat the EPS. This TipRanks article says 25 cents consensus. That don't make sense. I thought it was 28, 29. Hmm. Why does it say that? Yeah, CEO sounds confident. Okay, he sounds really confident. The revenue growth is freaking 10% higher than last year's Q4. They went from 14 on the bottom to 23%. EPS off 2 cents. They're gonna go so much higher than whatever they put out. They're gonna do their 3 quarters in a row of EPS guidance beat. That's what I'm saying. Why would they? That's the part I don't get. I mean, they went up last year, went from 6 to 15, 7 to 15. That's 8 cents. If you bump up another 8 cents, you're at 34. So we're just off by like 2 damn pennies. And that's why I don't understand why they would take the risk of going 2 pennies like off their guidance. Yeah, doing stuff like that. That's pushing it now. Like this was the part to just go a little more aggressive and get your stock going up. Of course, if you put out numbers 2 cents under, you're gonna go down. So they may announce something on the call, crypto related or loan platform business related or Galileo related, but I love when people love to like emphasize the dips to be cooler. Like you're making a mistake on because they can time the market. That's it's kind of funny. Great. I don't know. 2027. Bye. Bye. A lot. Yeah, they should have just matched it. They should have just matched. That's what I'm saying. They should have just matched the expectations. That's what they should have did. But Microsoft's down 6%. Really? Is that true? Is Microsoft really down 6%? I'm gonna go look. Amazon's down 4. What the heck? Microsoft is down 6% and Nvidia's down 12. Yeah, that's crazy. The mega caps going on the sell chain. I'm not worried. It's I just know today this is not what people wanted. That's it. Just I know if you're not putting out your guidance that analysts want at 2 cents, I just know that's gonna get the algorithm selling off. I know that, but I'm impressed with what I'm impressed with is the growth rate right now. Like you're already starting out at 23 to 26%, and last year I had to look at 14%. So we're already going from 14 to 23. They're probably going to grow 34, 35% this year, guys. That's insane. That is insane. Um, yeah, just for anybody new or anybody here now, you can see right here. Um, 2025 guidance, 23 to 26. Wall Street wanted 18%. Adjusted EBITDA 845 to 865. Net income 9% margin. It's just right here. Diluted EPS 25 to 27. Wall Street wanted 29 pennies, man. This is how tight this market is, man. To the penny. So this is what guidance Q1's pretty soft. But yeah, this right here, this number right here is what got you. Um, remember, guys, I mean, we were we were down this much the last earnings report. Like we were down more than this. Am I tripping? Like we were down more than this last report. We were down like 15%. So like this could easily recover in like the next 2 days. Like it's definitely possible. The stock's not going to sell off much more for a 2 cent 2 cent miss. We'll see. We'll see what Noto has to say. EPS, 2 pennies off. 2 pennies off. We got fried. Come on, man. Buy the dip. I did see that. Go back to sleep. Sofi not joke. Market sell off. Bad timing. Buy. It's at 8. So 8 o'clock, 8 a.m. Yeah. Back to ramens. This could be a possibility. This is a possibility. How are ETFs doing? Let's see. Wow. QQQ's down 3.7. VU's down 2. VGT 5. Yeah. It's pretty ugly. It's pretty damn ugly out there, guys. All right, guys. Hopefully, Anthony Noto can explain the future of what's going on, why we went a little conservative for Q4 or 2025 earnings. Oh, yeah. We got some trolls in here. Trolls have entered the building, guys. Trolls have entered the building. Yeah. Troll Patrol. This guy's gone. He's already dropped. One of these dudes dropped like 12 freaking comments talking about who's trolling. You're putting 10 comments. Okay, let's see. Guys, we were like, what were we? We were down pre market last report, like 6-7%, something like that. Um, Financial services still growing. Record contribution profit. This something has it has to be something with this. Something with a top 10 deal out there is just it's got to be close at this point. Is what I'm saying. It's got to be really close. They grew 26% last year, and that was the Armageddon year. They grew 26% in the Armageddon year. Oh no. Yeah, guys. I mean, last time we last time we dipped like this, I mean, we went from we dipped like this like 15% and then we ripped up $7. You know what I'm saying? Um, they just hit 5 quarters in a row of profitability. Growth is accelerating for 2025, and profitability, they increase guidance every single quarter. So they're going to likely finish the year out, over 35. So are you guys saying we would be green if they put out 2 cents higher EPS? Maybe. Maybe. It's possible. All right, how long? Okay, I get this, but like, I wouldn't think this is gonna last an entire day. Like I thought these dips were gonna be bought up in the overnight. You telling me there's people are still not buying the dips? Are you serious? People still not buying the dips on them chip stocks and stuff? Yeah, people are not really buying the dip right now. Amazon's down 5%. What is going on? Yeah, we got about 18 minutes till the call. No fucking way. In the pre-market? There's no way. There's no match between EPS growth. That I agreed with. The growth for last year was 26%. They said 14, and they're already accelerating growth to 23 to 26% to begin with. We know that's it's going to go a lot higher. Maybe they're still going to pull off 40 cents for this year. Maybe they still have 40 cents in the bag possibly. I don't know. It's a possibility, but when you're talking pennies, like remember these earnings, these algos, they play it to a penny, and they did not have enough. They did not have enough pennies. Yeah, can the other part of the market, like, can the other parts of the market recover? Because they're not recovering at all. Like Amazon 4, Tesla. Like, why isn't anything recovering? Like, how is this? How is this deep sea that crazy? Like, can't believe it. Microsoft 5, Nvidia is still down 11.5. What? Man. That's crazy. Well, I know, man. It's weird. It's a weird day. We already got the news, guys. We got the news. We already know the entire guidance and everything. Um, Small caps down 1%. That's like not that bad though. Maybe all these chip stock dips are gonna get bought up when the market opens, but it's not looking very good out there right now, guys. I mean, this is like some good opportunity. I mean, SoFi obviously missed by 2 pennies. So this is just a crazy day. Really, 16 on Nvidia? I mean, here the chip stocks are still doing the same shit. Like they're not moving. Like I thought these dips were gonna get just cleaned up immediately, and nothing's getting cleaned up at all. Like I don't understand. Like nobody's buying dips right now at all. Nobody's buying dips. This is like what the consensus and analysts on Wall Street wanted before the earnings report come out. It was either 28, it was either 28 or 29 cents, like for the full year 2025. It was either 28 or 29. Um, they didn't come out. They didn't hit 28, 29. All right, back to 12. Yeah, crash. Wait for market open. It beat Q4 earnings. Q4 it beat the Q4, like they destroyed revenue just like I thought. EPS was 5, consensus was 4. They beat that. Um Q4 was 5. Let's see what he can do. Fed meeting Wednesday. It wasn't what we expected. Let's just say that revenue was good, but the profitability wasn't very good at all. Yeah, pretty much. We're we're qualified for profitability. We're not for market cap. We have to be like $18. So no, we're back out of the 500 category until we get back over $18. Well, call starts in 5 minutes. What news? Ugh, I ain't doing that. Those are nasty. China number one. Okay, guys, we got 4 minutes till Noto releases the call, and the stock is getting clipped in pre-market. Like they're acting like SoFi just fucking declared bankruptcy. Jesus, it's 2 damn pennies. God, this is bullshit. Here, I'll put I'll put SoFi next to all the other tech companies like there's a plane behind me. No, I just don't think that that's the actual EPS that they're gonna finish out the year because we know how SoFi likes to operate. They like to increase guidance 3 times. So I just think EPS is gonna be so much higher. I just don't know why they wouldn't have made it a little higher to start, maybe. So yeah, so I don't know how like institutions are gonna react. Maybe maybe they see it as an opportunity because like I said, it's like it barely missed like guidance at all, you know what I mean? So here are all the other companies right now. You can see Hood's 5, Palantir 6, Firm's 4. So looks like some people are starting to buy the dip finally. All right, guys. Earnings call. Anthony Noto, 1 minute. 1 minute to the call. 1 minute. Oh my god, you guys say the stupidest stuff. um, this one. Try this one maybe. Like that. You, you get the earnings call any minute now. Stock's acting so weird. Can you hear? Is it good?
one example. Over the years, we built a powerful lending platform with strong member acquisition, underwriting, and servicing capabilities. But prior to 2024, we had two options: hold loans on our balance sheet to generate net interest income, or to sell loans to manage our balance sheet size, risk, and capital. This past year, we created greater optionality to meet the strong demands from our members and capital markets buyers through LPB. Here's how it works. We partner with buyers like Fortress to originate loans fitting their predefined criteria, and we earn fee income as we fill the orders. These loans are originated on the buyer's behalf, so they don't sit on our balance sheet. And importantly, we keep the servicing rights. This model is a game changer. It allows us to serve more members, including people that we might have otherwise declined for a variety of factors without taking on incremental risk or capital. It further diversifies our revenue with additional fee-based income. And because we keep the relationship, we have the opportunity to provide the members with additional products and services. In 2024, we originated $2.1 billion of loans through LPB, which brought our total company loan originations to $23 billion. Beyond LPB, we've continued to build and enhance products in our financial services segment. In just a few weeks, we'll introduce a variety of new benefits across our one-stop shop and a new fee-based subscription option for Sofi Plus. Our premium membership tier, Sofi Plus, has been incredibly popular, but only available to members who enroll in direct deposit. For the first time, members can access our highest APY, a 1% match on recurring invest deposits, extra cash back on Sofi travel, interest rate discounts, and more for a low monthly fee. We will provide Sofi Plus members with more than $1,000 of value annually unlocked by paying a monthly subscription or doing a monthly direct deposit. In Q4, our investments expanded access to alternative investments through partnerships with 3 new private market funds, including the Templum Cosmos Fund, which offers sole exposure to SpaceX, and through our new robo-advisor platform developed in partnership with BlackRock. Having access to alternative investments is a top priority for many retail investors, and one way we're helping our members achieve their ambitions. Sofi now has 2.5 million invest products, with 70% of the growth coming from existing Sofi members. We continue to iterate on the value proposition, which is driving 2 dimensions of growth: engagement and monetization, both of which we believe will double in the intermediate term. In credit card, we continue to thoughtfully position our business for future growth. We improved our underwriting and rolled out 2 new products tailored to our members' needs: the Everyday Cash Rewards and Essential Credit Cards, helping more members earn rewards and build their credit. Our financial services segment also operates as a marketplace where we connect members to third parties and collect referral fees. For example, we make loan and banking referrals for borrowers we don't currently serve, including small and medium-sized businesses. We also refer members to partner insurance carriers through our Protect product. While still small in the context of Sofi, these referral revenue streams that are high margin grew significantly in 2024. That takes me to Sofi Money, our most successful financial services product, which serves as an example of what these other businesses can become. Since 2020, Money has scaled significantly. Products grew from 646,000 to 5.1 million products today, and increased 51% just this year. Money helped drive nearly a 9x increase in revenue per product for financial services overall. Since acquiring our bank license in 2022, we've grown our deposits to $26 billion by iterating, learning, and iterating to make our product, marketing, and service better every day. For example, we know that frictionless money movement is top of mind for our members, so in 2024, we introduced Zelle and improved our self-service wire transfers. We believe Invest is the next business to follow the footsteps of Money, and we plan to allocate greater resources in 2025 to scale this business. Turning now to Tech Platform, another fee-based segment. Our Tech Platform gives a broad range of clients, from banks to fintechs to consumer brands, the ability to create, launch, and run financial products. In 2024, Tech Platform reached 168 million total accounts, up 15% year over year. Entering 2025, we are seeing strong demand from new potential partners. Let me give a few examples from the past few months that demonstrate the diversity of our client base and the strength of our offering. First, we recently were selected by the U.S. Department of Treasury for Direct Express, a prepaid debit card program that approximately 3.4 million people use to access their federal benefits. This is a testament to our tech platform's differentiated offering, as well as our strength and reliability. We're excited about the integration that will take place in 2025 and the financial impact that we will see in 2026. Second, we just signed a large U.S.-based financial services provider that offers short-term consumer loans, card services, check cashing, and other financial products. They've built a large, loyal, and highly active debit card portfolio over the past 2 decades and will now rely on our technology to power existing and new capabilities. Once they fully transition to our platform in early 2026, they will be a top 10 client on a revenue basis. Third, we've signed a partnership with a leading hotel rewards brand for a co-branded debit card program launching in the first half of 25. This is a new differentiated offering that will expand our footprint among consumer brands. These deals represent more predictable revenue from larger established brands with notably higher average deal sizes. We're excited about these wins and would note that the implementation and the integration cycles will be gradual and the revenue impacts will most likely be felt in 2026. As you can see, 2024 was a tremendous year overall. Our record revenue, profit, members, products, and returns all demonstrate the success of our innovation and brand building and are a testament to the absolute grit of our team. I have never been prouder of a year-long performance than I am of 2024. Even with how great 2024 was, the future has never been brighter for Sofi than it is in 2025. The operating environment is the strongest it has been since I joined, with lower interest rates, strong employment, active capital markets, and we have a vibrant brand and the only digital one-stop shop offering in the U.S., resulting in a diversified business model that is well-positioned to capture the opportunity ahead. With that, let me turn the call over to Chris to provide more detail about the quarter and year and to share our detailed guidance for 25.
Thank you, Anthony. 2024 was indeed our best year ever, and we finished strong with an exceptional fourth quarter. Adjusted net revenue for the quarter was a record at $739 million, up 24% year over year and 7% sequentially. Adjusted EBITDA was also a record at $198 million with a 27% margin. Excluding the non-recurring benefits related to deferred taxes, adjusted net income was $61 million and adjusted EPS was 5 cents. This was our 5th consecutive profitable quarter and first profitable year. As noted, our fourth quarter GAAP results included non-recurring tax benefits of $271 million. These were primarily related to the release of the majority of the valuation allowance against our deferred tax assets. Each quarter, we assess the recoverability of our net deferred assets, most of which are related to net operating loss and tax credit carryforwards from prior years. The timing of this release was due to our recent strong financial performance and forecast of continued profitability. Moving forward, we expect a normalized effective tax rate of approximately 26%, which can be impacted by future discrete tax items and mix of income. Turning now to our segment performance, starting with our non-lending segments, which comprised a record 49% of total adjusted net revenue during the quarter, reflecting the continued diversification of our business. Starting with financial services. For the fourth quarter, net revenue was $257 million, up 84% year over year. Contribution profit was $115 million, up 4.6x year over year. Contribution margin improved significantly to 45%, up from 18% last year. Net interest income for this segment was $160 million, up 47% year over year, which was primarily driven by growth in consumer deposits. Importantly, non-interest income grew 3.2x to $96 million in the quarter, which equates to nearly $385 million in annualized revenue. In Q4, our LPB business generated $63 million in fees, driven by $1.1 billion of personal loans originated on behalf of third parties, as well as referrals. Additionally, LPB generated $4 million in servicing cash flow, which is recorded in our lending segment. In total, our loan platform business added $67 million to our adjusted net revenue across these two segments. We're off to a strong start in Q1 as well. Our loan platform business recently agreed to initial terms with Blue Owl Capital Funds for up to $5 billion of personal loans over 2 years. Once finalized, this arrangement will represent our largest LPB agreement to date. In addition to our LPB revenue, we continue to see healthy growth in interchange, up 63% year over year, driven by $14 billion in total annualized spend in the quarter across money and credit card. Shifting to our tech platform. For the fourth quarter, we delivered net revenue of $103 million, up 6% year over year. Contribution profit was $32 million at a contribution margin of 31%. Revenue growth was driven by continued monetization of existing clients, along with new deals signed in new client segments. Our recent client wins have been more diverse, including major consumer and commercial brands, as well as large enterprises in Latin America. Turning now to our lending segment. For the fourth quarter, adjusted net revenue was $423 million, up 22% from the same period last year. Contribution profit was $246 million, with a 58% adjusted margin. These strong results were primarily driven by growth in net interest income, which increased 31% year over year to $345 million. This included a 23% increase in average interest earning assets and a 68 basis point decrease in cost of funds, which was mostly offset by a 62 basis point decrease in average yields. During the quarter, we achieved record loan originations of $7.2 billion, up 66% year over year. Personal loan originations were a record at $5.3 billion, of which $1.1 billion was originated on behalf of third parties through LPB. Collectively, personal loan originations were up 63% year over year. Student and home loan lending both had their best quarter since 2021. Student loan originations were $1.3 billion, up 71% from the same period last year. Home loan originations were $577 million, an 87% year-over-year increase. The fourth quarter was our best quarter of capital markets activity since going public. Overall, we sold or transferred through LPB over $3.4 billion of personal loans, home loans, and secured loans. In terms of personal loans, we closed $950 million of sales in whole loan form at a blended execution of 105.5%. We also closed a $525 million private ABS transaction that included significantly lower WAC collateral relative to our balance sheet at an execution of 102.3%. All deals had similar structures to other recent personal loan sales, with cash proceeds at or near par, and the majority of the premium consisting of contractual servicing fees that are capitalized. These sales included a small loss share provision that is above our base assumption of losses and immaterial relative to the exposure we would have otherwise had if we held the loans. In terms of home loan sales, we closed $507 million at a blended execution of 100.7%. Additionally, we sold $90 million of late-stage delinquent personal loans. By selling these loans, we're able to generate positive incremental value over time versus selling after they charge off, both from our improved recovery capabilities and by maintaining servicing. Finally, we sold $243 million of secured loans at a par execution, while also executing $199 million of new secured financing. Net-net, inclusive of all new issuances, paydowns, and loans sold in period, our secured loan balance decreased by $189 million sequentially. Turning to credit performance, the health of our consumer remains strong. Our personal loan borrowers have a weighted average income of $158,000 and a weighted average FICO score of 744, while our student loan borrowers have a weighted average income of $134,000 with a weighted average FICO score of 765. Our credit trends continue to improve after seeing delinquencies peak in the first quarter of 2024. For personal loans, the on-balance sheet 90-day delinquency rate was 55 basis points in the quarter, a slight decrease from 57 basis points in Q3. The annualized charge-off rate declined to 3.37% versus 3.52% in the prior quarter. Had we not sold any late-stage delinquencies, we estimate that including recoveries, we would have had an all-in annualized net charge-off rate for personal loans of approximately 4.9% versus 5.0% last quarter. For student loans, The on-balance sheet 90-day student loan delinquency rate remained flat sequentially at 12 basis points, while our annualized charge-off rate decreased 7 basis points to 62 basis points from 69 basis points last quarter. The data continues to support our 7 to 8% maximum life of loan loss assumptions for personal loans, in line with our underwriting tolerance, although we continue to trend below these levels. Our recent vintages, originated from Q4 2022 to Q1 2024, have net cumulative losses of 3.8%, with 45% unpaid principal balance remaining. This is well below the 5.25% observed at the same point in time for the 2017 vintage, the last vintage that approached our 7 to 8% tolerance. The gap between the newer cohort curve and the 2017 cohort curve widened by 15 basis points, demonstrating continued improvement. Additionally, looking at our Q1 2020 through Q3 2024 originations, 58% of principal has already been paid down, with 6.5% in net cumulative losses. Therefore, for life of loan losses on this entire cohort of loans to reach 8%, the charge-off rate on the remaining 42% of unpaid principal would need to exceed 10%. This would be well above past levels, further underscoring our confidence in achieving loss rates below our 8% tolerance. Turning to our fair value marks and key assumptions. As a reminder, we mark our loans at fair value each quarter, which considers a number of factors, including the weighted average coupon, the constant default rate, the conditional prepayment rate, and the discount rate, comprised of benchmark rates and spreads. At the end of the fourth quarter, our personal loans were marked at 104.9%, down 80 basis points from the end of the prior quarter. This change was a function of the discount rate increasing by 51 basis points to 5.29%, mostly due to the underlying benchmark rate increasing by 63 basis points, partially offset by 12 basis points from spread tightening. As we've previously noted, both of these changes are empirical based on the actual market data, not assumptions. Additionally, any fair value impacts that resulted from interest rates increasing were offset nearly 1-for-1 by hedge gains. Furthermore, we saw a 10 basis point decrease in the weighted average coupon. Slightly offsetting those negative impacts, we had a slight decrease in our conditional prepayment rate from 26.1% to 26.0%, which has an immaterial impact on the overall change in the mark. When a borrower prepays, we are still capturing the principal, and the impact to the value of the asset is only based on the premium above par at a given point in time, which is very small relative to the principal outstanding. At the end of the fourth quarter, our student loans are marked at 104.1%, down 133 basis points from the end of the prior quarter. This change was a function of the discount rate increasing by 41 basis points to 4.4%, driven by the underlying benchmark rate increasing by 76 basis points, partially offset by 35 basis points from spreads tightening. Additionally, we saw a 28 basis point increase in the conditional prepayment rate from 10.7% to 11.0%. There were no material changes to the weighted average coupon rate or the conditional prepayment rate. Turning to our balance sheet, where we remain very well capitalized. In the fourth quarter, total assets grew by $1.9 billion, driven by approximately $910 million of loan growth, approximately $830 million of growth in other assets, and approximately $80 million of growth in cash equivalents, and investment securities. Total liabilities grew by $1.5 billion. This was driven by member deposit growth of $2.6 billion quarter over quarter, while non-member deposits were reduced by $1.2 billion. Total deposits reached nearly $26 billion in the quarter. Over the past year, our strong organic deposit growth has further strengthened our balance sheet. Currently, there is a 193 basis point difference between the interest we pay on deposits and the interest we pay on warehouse lines, which translates to approximately $500 million in annualized interest expense savings from growing our deposit base over the past year. We continue to benefit from the mix shift towards deposit funding, along with our ability to sustain healthy deposit versus lending betas. As a result, we reported an average net interest margin of 5.91% for the quarter, up 34 basis points sequentially. This is a function of maintaining asset yields and reducing our overall cost of deposits. This continues to be in line with our expectation of maintaining NIM above 5% for the foreseeable future. In terms of our regulatory capital ratios, our total capital ratio of 16.2% at year-end remains comfortably above the regulatory minimum of 10.5%. Tangible book value grew $465 million sequentially to $4.9 billion, including the non-recurring benefits related to deferred taxes. While these are non-recurring benefits, it is value retained in the business. Tangible book value per share at year-end is $4.47, up from $3.61 a year ago. Looking forward to 2025, after a year of bolstering our capital base, reaching GAAP profitability, as well as the scale required to drive continued profitability, we want to better tilt our incremental revenue growth toward investment. We have significant untapped addressable markets in front of us, and we have proven that the more we invest, the more we produce durable growth and strong returns. In 2025, we plan to manage towards an incremental EBITDA margin of around 30% as we reinvest in the business to drive that durable growth of 25% again in 2025 and ultimately strong returns well into the future. Let me finish by providing our outlook for 2025, starting with the macro assumptions that underpin our financial guide. In line with market expectations, our assumptions are as follows. An interest rate outlook consistent with the forward curve and just north of 1.5 rate cuts, GDP expansion of 1 to 2%, normalization of unemployment in the 5% range, and continuation of normalized credit spreads across capital markets and stabilization of consumer credit. Now for our specific guidance. For the full year 2025, we expect to add at least 2.8 million members, which represents at least 28% year-over-year growth. We expect adjusted net revenue of $3.20 to $3.275 billion, which equates to year-over-year growth of approximately 23 to 26%. We expect an adjusted EBITDA of $845 to $865 million, which equates to an incremental EBITDA margin of approximately 30% in line with our investment philosophy that I just outlined. We expect adjusted GAAP net income in the range of $285 to $305 million, which equates to an incremental margin of 20% when excluding the 2024 net gain of $63 million related to the exchange of a portion of our 2026 convertible notes for equity. We expect adjusted GAAP EPS in the range of 25 to 27 cents per share. As I mentioned, this guidance assumes a tax rate of 26%, which we currently believe to be our effective tax rate in 2025. We expect growth in tangible book value of $550 to $575 million for the year, and to end the year with a total capital ratio above 15%. For the first quarter of 2025, we expect to deliver adjusted net revenue of $725 to $745 million, adjusted EBITDA of $175 to $185 million, GAAP net income of $30 to $40 million, and GAAP EPS of 3 cents. It's important to note two items when comparing Q1 2025 to Q4 2024. First, we expect to have a 26% effective tax rate versus an immaterial impact from taxes on pre-tax income prior to releasing our valuation allowance. This translates to approximately $15 million of expected taxes in Q1. Second, each year we have seasonal payroll taxes during the first 2.5 quarters of the year. This translates to approximately $10 million of incremental operating expenses in each of the first 2 quarters. Looking beyond 2025, we now expect to exceed our medium-term guidance of delivering 20 to 25% compounded annual revenue growth through 2026, and we remain confident in delivering 2026 EPS in the range of 55 to 80 cents per share. Moreover, we are well positioned to deliver 20 to 25% annual EPS growth beyond 2026. Overall, 2024 has been a remarkable year for SoFi. We are proud of the strong results we delivered and remain confident in our ability to build on this momentum as we move into the year ahead. With that, let's begin the Q&A.
At this time, I would like to one on your telephone keypad. Please keep in mind we'll only take one question per person at a time. Please rejoin the queue for any additional questions. And our first question comes from Kyle Peterson from Needham & Co. Kyle, please go ahead. Your line is open.
Great. Thanks, guys. Good morning. Appreciate you taking the question. Want to start, on the funding side of the equation that really helped in this quarter. You guys added quite a few deposits. Looks like you've taken a little more action on the deposit side in terms of lowering APYs compared to some of your competitors, but are still growing at a really nice clip here. So just wanted to see if you could give any more color on how you guys have been able to drive back the costs a little more than some peers, despite perception that we might be in a higher for longer type of environment than it looked like even 3 or 4 months ago.
Yeah, I'm not sure I understand the question, so clarify if we don't get it right. I think the first part of your question was we've lowered interest rates on our APY for SoFi Money, and what impact has that had, and how do we think about our funding costs overall and maintaining them. First on the APY, we want to have a top tier APY. It's an important element of our value proposition. SoFi Money's been a phenomenal product. It's the gold standard of what we're going to do with each one of our businesses. When we started, we had negative unit economics. Then we got the variable profitability, and then from there we scaled the variable profitability above our contribution, our cost to the positive contribution margin. And now it's really cranking, and we're acquiring a significant number of customers. Obviously, the payback period is not instant, so we're funding that within the business and still driving a really high margin. We are seeing really strong trends in growth with our APY changes that we've made, both in terms of members and deposits. And we think we can maintain really strong member growth, even if our deposit growth slows as we think about managing our assets and liabilities in the balance sheet and our funding costs. I'll let Chris add some additional color on the funding side.
Yeah, absolutely. So what I would say is we're now currently at the point where we're close to our long-term funding target of 85 to 90%. That's been a rate that we've talked about consistently over the course of the last few years. So while else being equal, we'd like to grow deposits at a similar pace to our overall loans, which we expect to be in the single-digit billions in 2025, which will be slightly less than what we did in 2024. However, as Anthony just noted, if we're seeing exceptionally strong member demand, we can grow a bit faster and deploy that funding through incremental loans or other assets. Additionally, we have other ways to obviously manage deposits on the balance sheet through pricing and other means. Finally, the only other point I would note is that we're still expecting really strong member growth north of 28%, and that's going to be a function of the continued momentum that we're seeing in money, but also an acceleration in credit card, invest, and other financial services products.
And I would just make one other point about SoFi Money and its role strategically in our overall strategy. It's the tip of the sword, so to speak, in the first product many of our members take, and then they gain that trust and reliability with SoFi, and then they take on other products. So the lifetime value from a money member grows over time as they use more products and services, which is also a consideration when we think about that product. The last thing I'd say is what we've seen is that the value prop of SoFi Money is much more than the APY. Having Zelle is really critical. People want a safe, secure way to be able to send money person to person. We also provide person-to-person payments via just a phone number or email, in addition to bill pay, free overdraft, the 2-day early paycheck, and we'll continue to add other features and functionalities to make that really valuable. The reason for SoFi Plus and the subscription is to actually provide more than $1,000 of value annually through a subscription of $9.99 or through direct deposit. And so that value prop will just continue to increase because we have lower costs, better margins that we can reinvest in greater appeal.
The next question comes from Dan Dola from Mizuho. Dan, your line is open. Please go ahead.
Hey guys, great results here. And I was going to ask you a question about the lending platform, but we are getting a lot of questions this morning from investors regarding your medium-term EPS guidance. So maybe it's really great to see you reiterate the guidance. But now, given that you're leaning into investments, can you give us some examples of like operating leverage items that you have that would maybe increase the confidence on investor side that EPS target can be actually beaten? That would be great.
Yeah, so I'm going to take a step back and elevate out for a second to give people perspective. we think the winning formula is to drive durable growth and strong returns, and we do that by driving innovation and brand building. We couldn't be more confident in the long-term margins of the business. What we said historically is that our EBITDA margin long-term will be 30%, and our net income margin long-term will be 20%. And we believe we can drive to a very high ROE, well above other financial institutions, with those margins and our high fee-based business, as well as we think about the capital elements of the business. In 2023, we had set guidance with a 30% incremental EBITDA margin. We said our margins long-term would be 30%. So in that time period, we wanted to show evidence of that and manage the balance of growth and profitability by delivering a 30% incremental margin. If you do that over time, asymptotically, your margin becomes 30%. In 2024, we took a very conservative stance at the same point last year relative to others based on interest rates, the economy, inflation, geopolitical, et cetera. And because we took that very conservative stance, we drove margin expansion at the expense of revenue growth. And we delivered well more than 30% incremental EBITDA margins, which is evidence that we can do that and maintain growth, having just grown 25%, which is well above the revenue expectations that we established last year in January. So we couldn't be more confident that our long-term margins are 30% for EBITDA and 20% for net income. And in 2025, we're just tilting the balance back to where we were in 23, which is a 30% incremental EBITDA margin, because that allows us to ensure we're investing today to drive durable growth beyond today into the future in revenue, in products, and in members. The thing that's most important about our guidance, which we just provided, is our revenue expectations are higher in 25 than the street had and what we had previously had, and our revenue expectations for growth into 26 are now higher as well. And that's possible because of the resource we have to invest in the business and the open opportunity in front of us. So couldn't be more confident in a long-term outlook for the company from a margin standpoint, and want to make sure we're taking a long-term view to drive revenue growth for as long as we can. And when it slows, then we'll drive the margin growth.
The next question comes from Terry Ma from Barclays. Terry, your line is open. Please go ahead.
Hey, thank you. Good morning. I just want to ask about the lending business overall. Your originations in the fourth quarter are quite a bit ahead of our estimates. So I'm just curious, how are you thinking about the lending business in 2025 with respect to originations and balance sheet growth? And then also, what's kind of contemplated in your guide with respect to the loan platform business?
Yep, absolutely. In terms of the overall revenue growth for our lending business, what we expect for 2025 is that we're going to grow low double digits to teens as we continue to see strong borrower demand across both our personal and student loans, and we start to scale our home loans business in a more meaningful way. We now have our back-end fulfillment capabilities in place, and we have a full suite of products that we're able to work with. And then in terms of our medium-term guide for the lending business, we're still on track to hit that mid-teens growth compounded 2023 to 2026. As I mentioned before, as it relates to our balance sheet, we're expecting to grow the balance sheet modestly in terms of single-digit billions. But that doesn't mean that we won't be able to grow other parts of the business at a more rapid pace through all of our fee-based income streams. In terms of how we're thinking about the loan platform business going forward, we couldn't be more optimistic about it. We believe the business is just getting started today. We have that $2 billion agreement that we signed with Fortress last quarter, and that relationship continues to expand. And we also agreed to terms for a $5 billion 2-year deal with Blue Owl Capital Funds, as well as having commitments for the rest of 2025 with other partners, including top investment banks, as well as private equity funds. We're obviously one of the very few partners who has the marketing and operational capabilities to deliver assets at scale with the characteristics and return profile that investors are seeking. So really good momentum and demand that we're seeing from loan buyers there.
The next question comes from John Hecht of Jefferies. John, your line is open. Please go ahead.
Morning, guys. Thanks very much for taking my question. I guess just a little bit of a tack on from the last response, Chris. The loan platform business, obviously really strong results, really good growth. but also pretty supportive capital markets. How do you guys think about that in a more volatile interest rate or a volatile kind of capital markets environment?
Sure. Thanks, John. So what I would say is we have good visibility into the appetite for our paper, as well as loan buyer demand is remaining extremely strong. As I just mentioned, we have commitments for the rest of 2025 from Fortress, Blue Owl, and some of the others that I mentioned. More broadly speaking, though, we've built a resilient, diversified business with multiple avenues for borrower loan demand, including holding loans on our balance sheet, selling loans either through whole loan format or through ABS structures, and referring loans to third parties. So we're really confident that we'll be able to efficiently monetize the demand that we're seeing from borrowers today. Additionally, we have other ways that we can drive fee income growth. You'll continue to see strong growth in interchange, which ended up increasing 63% this quarter. Also the brokerage business as we continue to improve our monetization with Invest, and then fees related to tech platform and fees from our new SoFi Plus offering that Anthony discussed during the prepared remarks.
And one of the things that we broke out in the prepared remarks, in case anyone missed it, is that we're now providing a perspective on what our total fee-based revenue was across all of our businesses. And for the year, it was $970 million, which was up 74%. And again, that's driven by origination fees, loan platform business, referrals, as well as interchange and brokerage. And for those that may not be familiar with the accounting, the loan platform business is cash upfront as opposed to gain on sale accounting. So it has an additional characteristic to it that's very favorable for us, especially on the credit and capital side.
The next question comes from Mihir Bhatia from Bank of America. Mihir, your line is open. Please go ahead.
Good morning. Thank you for taking my question. I was just wondering if you could provide, as we think about 2025, maybe provide a little bit more on your expectations at a segment level, both from a revenue, but also a contribution margin standpoint. Particularly curious about the financial services segment, where I think Anthony said might be in the Invest business, there's going to be some investment there. So just trying to understand how those evolve next year. Thank you.
Absolutely. So overall, we're expecting 23 to 26% revenue growth this year. We now expect to exceed our medium-term guidance that we laid out at the beginning of last year of 20 to 25% compounded annual growth. So we're really optimistic about the opportunity that we have ahead of us. In terms of the specific segment level guidance, for financial services, we're expecting very strong growth in the range of 60 to 65% as we continue to grow products and overall monetization. We're currently trending well ahead of our medium-term 23 to 26 guide of 50% annually, and now we expect closer to around 65% over that same period. For lending, as I just mentioned, we're expecting to grow 2025 low double digits to teens as we continue to see good demand both on the personal loans and student loan side, and we start scaling home loans. In terms of the medium-term guide for lending, we're still on track for the mid-teens growth 2023 through 2026. And then for tech platform, we expect to grow 2025 low double digits to teens. And given that lead times and implementation cycles have been longer than expected, we now expect to grow revenue at a mid-teens CAGR from 2023 to 2026. In terms of the margin profile, you can expect financial services, we're at about a 45% margin and $81 of annualized revenue per product. We're still under monetized in Invest, so there's opportunity, and we're starting to scale our loan platform business, which is generating margins around 50%, slightly north of that. So you could expect to see continued margin expansion in that business. Within lending, we've been consistently in the mid-50s to mid-60s range. You could expect that trend to persist going forward. And then from a tech platform perspective, we expect healthy margins in the 30% range in the medium term.
And then just elaborating on the investments that we're going to make in financial services, we announced, obviously launching at the end of this month, SoFi Plus. That's going to expand the availability of this great value equation of more than $1,000 in annual value to more people, especially those that may not have direct deposit capabilities because they're self-employed, but also other people that are younger and aren't actually in the workforce today. It's a great value for the price point on a monthly basis, and you more than recoup your subscription fee for the year. So that will have a significant amount of investment. In addition to that, we really want to accelerate our growth and invest. We think it's the next business like money to follow the same path. It's well on its way, but it's still really early days. We've seen great growth in all the key metrics there in terms of account openings, fundings, average deposits per account, average assets per account, and our monetization is also improving there. So we'll continue to get those dual drivers of growth. In addition to that, we've invested in small, medium business capabilities in 2024. We fully integrated the application process into our app, the Sofi app, and we're using partners to fulfill that demand for loans, and that's grown quite nicely. Similar approach to our insurance business, which we call Protect, home, auto, and life, also a big contributor and one we want to grow much faster. That saw really good growth in 24, small relative to Sofi overall, but a big area for us. And then last, our credit card business will be very methodical about our approach there. We think we have the right formula, but it is a business that you have to really manage methodically given the J-curve of investment. And so that will continue to be losing significant amounts of money in the tens of millions of dollar range. So significant investment to make sure we have continuous S-curves of growth beyond 2025. And the formula is really working. We said in the call that 30% of our products are from existing members, and 40% of our members take a second product within 30 days. So we want that flywheel to keep flying.
The next question comes from Reggie Smith from JP Morgan. Reggie, your line is open. Please go ahead.
Hey, good morning. Thanks for taking the question. I wanted to dig into the loan platform business a little bit. I think you guys said that those are primarily loans that did not meet SoFi standards, at least today. Was curious if this could become a channel where you do sell loans that are higher quality to partners. And then secondarily, do you charge origination fees on those platform loans? Thank you.
Yeah, well, let me answer the first part, and then I'll turn it over to Chris. It should be clear to everyone that we are actually selling loans that are high quality, but we're also selling loans that are outside our credit box, and they are also high quality. So there are two things that cause us to do the loan platform business. One, someone wants a credit profile that's actually within our credit box, but it's at volumes that we wouldn't otherwise produce. And so once we have the commitment from them, we'll go out and originate that volume, leveraging our origination platform, our underwriting platform, marketing, and servicing platform, and get paid a fee for that. So there's two things that drive it. One, someone will want volume above what we would actually produce ourselves and look to sell. That's within our credit box. And two, things are outside of our credit box. So it's both of those criteria. And in our view, they're all high quality. Some of them are more high quality, i.e. prime profile, which is what our profile is. I'll turn over to Chris on the fee side.
Yeah, in terms of how we think about structuring these deals, all of the deals where we're doing originations on behalf of third parties consist of two components. We have the flat fee per loan that we receive upfront at time of transfer. We not only get the flat fee from the those that we are originating on behalf of, but we also charge origination fees for a portion of the loans that we're originating. And then we also get a modest servicing fee that gets capitalized at the time of transfer. Both of those are recognized under non-interest income.
The next question comes from Andrew Jeffrey from William Blair. Andrew, your line is open. Please go ahead.
Hi, good morning. Appreciate you taking the question. Anthony, great to see the mix shift in revenue and the rise in fees as a percent of the total. Can you, sort of looking longer term, talk about perhaps where you'd like to see fees as a percent of the total, given your long-term ROE aspirations, and what the composition of that fee-based business might look like, say, either in an intermediate term time frame or even a little longer time frame?
Yeah, it's really hard to give you a specific number given it's being driven by 5 different sources of revenue. We would want it to be very significant. We recognize that it's capital light, it's less credit risk, obviously, and it's cash up front, so it's high. It's also high ROE. We want to grow it as large as we can. One of the things that we contemplate is, could we push all of our lending into the loan platform business over time? And I'm not opposed to that at all. The economics are very attractive. The velocity is much higher. The capital is lower. You have a lighter balance sheet. It would really support high ROE. Listen, we're students of the industry, and we see what drives high multiples, of whether it's revenue or earnings or book value, whatever the multiple may be, it's high ROE. So we have, I think, a great mix of businesses that we've told you will have a high ROE. The more we can drive fee revenue, the more visible that will become to you. So it was $907 million in the year. I hope it continues to increase as a percent of the mix, which I think it will, based on our outlook. So you'll continue to see an increase in the benefits that I just mentioned.
The next question comes from Jeff Anderson from Morgan Stanley. Jeff, your line is open. Please go ahead.
Hey, good morning, Anthony and Chris. You've talked a lot already about the opportunity in SoFi Invest to follow in the footsteps of SoFi Money, and it sounds like the SoFi Plus enhancements are a key part of that strategy. But any other specifics into your plans to really ramp up that business? Like, is it really just about allocating more marketing and generating more awareness, or are there any other features there we should be expecting? And maybe just talk a little bit about, sizing the monetization. Like, I think you're only doing on a quarterly basis about $6 million of brokerage revenues there. And then just sort of related to that, does that include any potential plans for maybe a re-entry into crypto, just given the current administration's thinking around that? Thank you.
So first, I would say the same thing about Invest as the rest of our business. The biggest gate to our growth is awareness and becoming a household trusted brand name. And so we're super focused on driving unaided brand awareness for the business overall and for each one of the products. And SoFi Invest itself, 70% of SoFi Invest products in growth in a quarter are coming from existing members. So the biggest driver for SoFi Invest is investing in broader awareness to our existing members, but also outside the platform. And so it's a great value proposition. We're differentiating on fast, on selection, on content and convenience, and we'll keep iterating on those four variables, as well as our products working better together. But the biggest driver of growth, given we do have a really attractive value prop, is driving more awareness of the product, both to members and non-members. We have over 10 million members now. You can see how many products we have on Invest. We haven't even penetrated our member base the way that I think we can, in addition to going outside the walls. But we will continue to add more and more selection. This quarter we added more alternative assets. Alternative assets were originally launched at the beginning of 24. It had a pretty big impact on the growth of both accounts, funded accounts, and AUM, because it's like a grocery store. People come in to get the milk and they see everything else is there. And so it has an indirect benefit that's really paid dividends. And so we'll continue to invest in that business, both directly as well as part of SoFi Plus. And there's a lot of features and functionality we don't offer today that will continue to add value and differentiation. And then on your question on crypto, listen, when we architected SoFi Invest, one of our differentiators was we wanted SoFi Invest to be a one-stop shop on its own. So we launched with no commission equities. We pioneered fractional shares. We created ETFs at a $10 price point because we wanted our members to have a diverse portfolio they can invest in a dollar cost way, and $10 was a great price point to do that in S&P 500 types of index in ETFs. In addition to that, we have our robo accounts. We pioneered IPOs in a turnkey way. We've added alternative assets. When we launched, we really debated, do we need crypto? Do we not need crypto? We went out to our member base back in 2018, did a survey of our member base, and they absolutely wanted crypto, and we provided it in a safe and sound way and a responsible way. As the regulation changes, we will be incredibly aggressive tied to crypto and be in as many businesses as we can be across the entire platform. Previously, we were just doing trading. You can see us go well beyond that, depending on the regulation, including custody and clearing, trading platforms, asset-backed lending, and so many other areas. So we hope the administration and the regulators come up with clarity on what the outlook will be, but we will move as aggressively as anyone else once that is determined.
At this time, I would like to turn the call back over to Anthony Noto for closing remarks.
Thank you, and thank you for everyone for joining the call today. Over the past 7 years, we faced challenge after challenge in external environment impacting our business, our members, and our team. And each time, through our innovation and tenacity, we've been able to run to daylight and come out even stronger than before. The result is a more diversified, resilient, battle-tested business, and most critically, a gritty team that finds a way to win. As I said before, we love hard. Hard is the path to durability. Hard is the path to differentiation. And hard is the path to being the absolute best. We enter 2025 with the best business environment we've had in my time at SoFi. But regardless of that outlook, rest assured we are battle ready. And while I'm confident our best days are yet to come, you should rest assured we will work harder and smarter than ever before to be the best in everything we do and to continue to build the SoFi way. Thank you for your interest and support in our great company.
Goodbye. That concludes today's conference call. You may now disconnect.
All right, guys, that's a wrap right there. Okay. All right, guys. Let's see. I'll give you a couple comments. Yeah, okay. So guys, this is starting to remind me of the Q3 earnings we had last quarter. Remember I just had that reaction, we blew out the earning. I mean, there was no full year guidance, and I just said, hey, this earnings, this bounce is gonna get eaten up. It's just because the magnitude of a 2025 guidance is so serious, you just had to really feel it out. Take a look at this, guys. So data-driven investing, heard this on the call. I was busy doing a lot of stuff. Just signed a $5 billion deal for the loan platform business. I think I heard over 2 years. Can someone correct me if that's wrong? Anthony Noto retweeted this. So guys, the loan platform business, we were excited about that $2 billion Fortress agreement. Remember the $2 billion Fortress agreement? And the stock was up 10%. Well, this is a $5 billion deal. And they said the Fortress deal is also expanding. So guys, they just went from 2 billion to 5 billion on this loan platform business. So just absolutely insane how fast that is already growing. I think Anthony Noto said he wouldn't mind transferring the entire lending business to only loan platform, which is no risk to the balance sheet, like no more, that's what he was saying. He's like, we could shift all the way to loan platform, if we want in the future. Like that blew me away. It just seems like the Galileo Tech platform, it's just these deals are so massive. They're taking so long that they keep, pushing out growth further, dropping the growth rates, mid-teens, 20 to 25 over 3 years and stuff like that. So yeah, guys, sorry about the call for the first 5 minutes. It was blocking my audio, flagging my audio or something. So I had to pull it up on my phone. So sorry about that for the first 5 minutes, but he just went over like the numbers, which we were looking at on the earnings call. So yeah, guys, they're going to blow away the numbers they put out. I think they did that to, brace for, Trump, Fed rate cuts, interest rates, inflation. I think they just braced for the EPS to go down, and I thought they were going to guide one rate cut, but they guided 1.5. So it just looks like they're going for more fee-based revenue. The growth is insane for 2025. They're accelerating growth dramatically. Yeah, guys, it really seems like Q3 a lot. Like we're at 5 quarters in a row profitability. Looks like to go from let's say they hit 15 cents 2024 EPS next year, 2025, let's say 30 plus, that's 100% growth in EPS. Hey guys, if you follow me on like Twitter and stuff, I'm going to be giving you guys all the institutional ownership updates. So if you see big buys coming in from institutional ownership go up, you'll know for sure that all this right here was retail selling out in the pre-market. If you start seeing these buys come in, you'll know that all this 15% sell-off was retail, and the stock will have a more stronger base going forward. Okay, so I think retail, a lot of people that have access to Robin, a lot of people trade on Robin. I mean, I think a lot of people sold retail on that earnings reaction of, a 3 cent miss. They missed by 2, 3 cents. But now they have the opportunity to just beat and raise, beat and raise, beat and raise. So, and of course, I'm not even, I keep forgetting, guys, I'm like pretending that this whole deep, whatever it is, the AI competitor in China, I keep forgetting that that's going on right now. I mean, I guess the whole market's crashing. I'm not even, I'm kind of just focused on SoFi. I keep forgetting. So maybe we would only be down 3, 4%, off of that if that wasn't going on right now. So crazy day, but I think you're going to see upgrades come in from the bullish analysts. I think you're going to start seeing upgrades into the $20 range. They're not going to drop their rating because of a 2 cent miss or something like that. They're looking at future growth. They also reassured the guidance for 2026. They're ahead of guidance. So we'll see. I think there's a possibility we could be higher by next week, maybe. We're just gonna have to see. Market opens in 25 minutes, so that's it. Hope you guys enjoyed the live stream. Anthony Noto seems more bullish than ever. We beat Q4. We beat the revenue 2025. Just slight miss on the EPS, and massive deal on loan platform. Looking to shift to more fee-based revenue. We'll have to see it. Deep seek. All right, guys, that is it. We didn't recommend any short-term weekly calls on this channel, just like last quarter. So we did not recommend any short-term trading or anything like that. So if that's what you did, that's on you. But we did not do any short-term options or anything like that. So do not blame me. Blame whoever recommended that. But I think the stock could go higher. Maybe next week it could recover once we get past this deep seek, and you'll see more of the bullish analysts come out in the SoFi stock. So pretty solid call. Maybe a B- earnings guidance. Revenue is still awesome. So we'll have to see. All right, guys, that's it. Hope you have a great day. All right, let's see how the market plays out. Later.